Welcome to the Dividend Talk podcast, episode 96, quarter one, 2022, crazy earnings week. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to discuss many companies' earnings as it was a crazy week. We'll do our best to pick as many companies as possible. All that and more. See you on the inside. Hey European DJ, how are you this week?
Oh, well, really good actually, because we are recording the show a little bit later, right? It's Sunday night. It's 1st of May. Happy Labor Day. I spent the day mostly at the river, making what we say in Poland an ognisko, a little bonfire with eating sausages, kids playing all around, and later still some, let's say, some alcoholic drinks. And, that's how you need to celebrate it, right? The Dutch have King's Day, which was last week. So we do it on 1st of May. So, but the alcohol is already a little bit up my blood, so I'm good for today. How about yourself?
Sounds good. Sounds good. I've had a good week. I was on my travels again. I went away with the missus. I'm only back today, so nice relaxing weekend in rural Ireland. Even though even though some people think that it's all just trees and sheep, it's no, it was a nice relaxing weekend away.
So, but now that we're both so relaxed, did you had any chance to listen in a little bit on Berkshire Hathaway's annual shareholder meeting then? Because that's kind of the Woodstock of the investors world, right? And also we're a big fan of the Buffett and Munger philosophy.
Yeah, yeah. I mean, it's the first shareholder meeting since 2019. And the two guys, they're not showing signs of stepping away or stepping down just yet, are they?
I think Munger is now 98, right? And Buffett 91. And I watched some pieces, right? And it was really funny where Buffett opened, I think. Well, I think it was in the opening where he said, like, it's quite interesting, guys. I can imagine that you want to know how the CEO is doing and you want to see them face to face, because if I would need to select invest in a company with a CEO that's 90 plus, I definitely want to see that old guy. So yeah, it was, their humor was again there, lots of fun, lots of jokes again. I really enjoyed it. And you know well, it's really interesting, right? We all the time get these, not so much anymore actually, but last year these questions about, oh guys, what do you think about Bitcoin, Bitcoin, Bitcoin? We usually ignore those questions also for the podcast. But this time it was also nice to hear Munger's perspective. Like, he wouldn't, I think it was Munger, yeah, that said, like, I wouldn't want to buy all the Bitcoin in the world even for $25 or something like that. And they have a similar thing as to gold, right? A similar position where they say, like, oh, if I would buy all the gold in the world, I could probably place it in the garden, and what can I do with it? Just hug it or something like that. And the similar thought process was also used to Bitcoin. Like, what can you really do with it? So, because there's no underlying asset below it, and that's also where I struggle with. I sit with blockchain and coins and such. I understand blockchain, understand the value, but I don't understand how you value a coin. And honestly, I also don't feel like studying it a lot. And yeah, I might miss out on some wealth creation, but I'm good with my dividend investing philosophy.
Yeah, they had quite a lot to say about Bitcoin. I think Robin Hood came in for a bit of criticism as well, the trading platform. What I found interesting though was that in the first quarter of 2022, they made 41 billion in net stock purchases, which I think equals maybe it was probably the most since they've recorded it in 2000 since 2008, which is quite incredible because you're seeing a lot of noise in the market lately, particularly uh, that we're in a downtrend and we're starting to see lots of different companies start to fall in price. But it's interesting that now, not when the pandemic happened, but now Warren Buffett and co are starting to buy stocks.
Yeah, and it's still the stock market is still quite a significant higher than 2 years ago, right? So
Yeah,
that's also interesting. And I believe they have still, what is it? I didn't check it, but don't they still have more than 100 billion on their balance sheet?
106 billion.
Ah, look at that. Come on. It's pocket change almost for what they invested in the first quarter.
Yeah, I mean it's easy to invest 41 billion when you have so much money on the sidelines, but it's still quite interesting to watch that. They
Mhm.
also, I mean, spent quite a significant amount of money on Chevron. I think at the end of 2021 it was around
Mhm.
4 billion or 5 billion maybe, and by the end of March it was up as far as 25, 26 billion. That's a quite a significant jump in one company.
Yeah.
And obviously you can see with energy, and that's paid off pretty handsomely for him, I'd say.
Yeah, I think Chevron is one of the best oil majors at the moment. Probably even positioned better than Shell and ExxonMobil if you look at it from a cash flow point of view. I haven't done my full due diligence on here as a full disclosure, but what I remember is that Chevron a few years ago had a lot of capex expiring, and those assets came online, so they can now really benefit from this operational cash flow, right? So yeah, the last time I studied it, they look pretty good. Yeah, cash is now just pouring in. So, and I think Buffett likes such kind of companies. And what I often hear when I study like more market cycles is that in the inflationary environment plus a potential recession, it's best to be in energy stocks and such. And I think maybe they are following that kind of logic here.
Yeah, I don't think he was too bothered about inflation. I know he was asked about
Mhm.
inflation, but I think his focus was more on buy quality companies, and you will beat the market no matter what the environment.
Ah, super. Well, then if we're talking about that, then what are some of the companies that really attracted your attention this week? Because it was crazy earnings week. I mean, half of my portfolio reported earnings.
Yeah, it was actually a crazy week. It's too hard to keep up with all of them. I just picked just a random few in my portfolio just to try and keep up to date. But one of them, I suppose, is AbbVie, which was the first company. They've had such so their stock price has gone up so much lately. So I think it was worth giving them a little bit of attention just to see how they were doing. And I have to say, initially it was quite good, but there was some mixed results in there. So the revenue was up, I think, 4.1% on a gap basis over the year. That's worldwide revenue. But they were affected by Humira sales, which decreased, I think, a lot more than they expected, particularly in Europe, as we know, they've lost the patent over here in Europe. That I think that decreased by about 3%, 3 or 4%. They also lowered their guidance on earnings per share. I think there was an 8 cent adjustment. Something got to do with the SEC anyway, where it made them lower their guidance by about 4 or 5 cent. And because of this lower guidance, it kind of affected their share price as well. But other than the Humira sales, we've seen strong growth in Rinvoq, Rinvoq, which we know that they're pushing really hard, and Skyrizi as well. Both of them increased. The revenue increased about 50, 60%, which is quite strong. Botox as well, which we know is another area doing that, also increased by 30, 33, 34%.
And
So
did they announce for the Botek docs whether it was volume increase or price increase?
I don't know. I don't know. I didn't see. So I don't know. I just on a reported basis, I just see it was 34%, but I didn't see if it was
Yeah.
volume or price.
Yeah, I'm just wondering whether after the Elegant acquisition, whether they have the opportunity to hike prices, because I think there's still some competition also in the aesthetics, right? It's not like with patents and everything. So I can imagine that although Botox is a really great brand, that it's hard to just hike prices significantly. So I'm assuming it's volume, but maybe we need to dive a little bit deeper there.
Yeah, I don't I don't think it would be that hard for them to increase prices on Botox. I think people that use that are needed. I don't know if there's an alternative. So maybe it might be easy to pass on those costs to the customer, but I'm not. I mean, I'm not a medical expert. I'm not 100% sure on that.
Yeah. Okay, cool.
But overall, I was quite happy with it. A little bit worrying about Humira, but obviously they are pushing Rinvoq and Skyrizi quite hard, and they are doing quite well as well. So it was a good report overall.
Yeah, so maybe that's also then where we can take one of the, I said, listeners' questions, because we had a listener question from, who was it? It was, yeah, Maarten. And he was asking, how do you guys expect the market to take the massive revenue loss from AbbVie in 2023 from loss of exclusivity for Humira? And he's wondering whether he should add in the 140s after earnings, but he's also expecting big drops in the stock from a year from now. And what was really nice when he posted a question also, that our big friend Dividend Wave, how I said, shared this picture. And what he's showing also is like there will be a lot of replacement of Humira. So let's assume that from this year to next year, Humira will go in half, right? Decline by 45%. We're still expecting Skyrizi and Rinvoq to grow by 30% and 50%. And that's why the overall, let's say, revenue should go from 28.4 to 21.9. Yeah, it's still 6-7 billion decline. But what you're seeing here is that, how is it? The other drugs are really starting to compensate for the patent cliff. And how I look at it, honestly, with a company like AbbVie, just assume that the profits are half of this and look at the multiple, and what would you pay for it still then? And for me, then the price is, how is it? Or the multiple is still okay, although I would like to have it, if I would add anything, I would rather go for the low 120s. Yeah, that would be my take on the company.
Yeah, I think at the moment they're a little bit too richly valued for me. I also believe that look, everybody knows what's going to happen in 2023. So I think that risk is already priced into the stock. I think it's been depressed sub 100 for quite a long time because they know that risk is there. Whether the stock price will go up or go down sharply will probably depend on how fast that decline happens, or if it's lower than expected. If revenues are lower than they expect, I think you said 22 billion, 21. If it comes in slightly lower, we know the stock price is probably going to be
Yeah.
punished, and the market's going to overreact because the market share and the decline in Humira is bigger than expected. So there is a risk to this. For me, the risk is probably bigger than the reward at these prices. Certainly, if it gets under 100, and I probably want it in around the 100 mark at the moment, that's when I would be buying. But anything above that, I'm just holding what I have for now.
Yeah, yeah, makes sense. Okay, yeah, I think it's a great biotech stock, let's say, or pharma stock, but for me, they are Maarten anyway too expensive at the moment, unless you start to look at it from a yield and assuming the yield is safe. I mean, you get it at 3.8 dividend right now, and if you expect it to grow 6-7% per year, it's a really nice deal. But if I look at it from a simply from a multiple point of view and my own valuation, for me, it's still like 20% overvalued right now. So for me, it's not attractive. But yeah, what goes up can come down again, right? So who knows?
Exactly, exactly. I think it's just hovering below its average yield. I think the average yield is around 4% or so.
Mm,
So it's still, even from a yield point of view, it's still attractive. I personally think it's going to come back down, but
yeah,
time will tell.
yeah. Good. That was Upfeed then. Then let's talk about the dividend talk darling Unilever with the shit CEO of Ellen Yopi. I can tell you their earnings were received very well this time. The company actually went up, and the reason for it is effectively, in my opinion, they were able to pass on the inflation to the customer because they had an underlying sales growth of 7.3%, which was mainly due to price increases. And I think this is probably all we can say even about the Unilever earnings. What was nice to see is that their 13 billion euro brands grew by almost 9% in the quarter. So it's clearly that those are the brands with a lot of pricing power. Also, e-commerce was growing double digits again. It's now already 14% of their sales, right? E-commerce, so also nice.
Yeah.
Um, but I guess what was also really nice for the company was their outlook, and they are expecting further price action because they are expecting more inflation in the second half of the year, also due to the impact of Ukraine. So they expect their sales growth to be around 4.5 to 6.5%, but then at the high end of that, so 6.5%, let's say, and a margin of 16 to 17%, probably around 16%. You need to know that why the stock got hammered last year was because they had a margin of 14%. So they are aiming in generally to do better than last year, and that's, I think, the reason why the stock went up. I would like to see this more consistently. One bird doesn't make a summer. I don't believe that the CEO has it all under control. So price hikes are easy, but he didn't do anything really here with his portfolio. They're aiming still at 1 July with this new kind of strategy that they have to implement it. I'm very skeptical. So I'm a long-term Unilever shareholder. I'm not selling. I want to own it for the next 2 decades, but I'm fed up with this CEO here, specifically after the GSK merger attempt. I'm just really fed up with this guy.
Yeah, I agree. One quarter is not going to it's not going to miraculously turn around this company. And I don't know about you, but a lot of products that I use in my house are probably Unilever products. And when I go to the shop lately, it's a lot more expensive than what it used to be. So I can see firsthand that they have definitely increased their prices, which, as you mentioned, is easy to do given all the hype and all the news about inflation. But they're still, I mean, they still haven't done anything. And there was one comment that I seen on on the report, and it's they are continuing to reshape their portfolio into high growth spaces. I mean, what does that even mean? What exactly are you doing
Yeah,
there?
bullshit.
Yeah,
Bullshit. This is becoming IBM, where you can put all the earnings reports one after each other and really do bullshit bingo.
yeah, exactly. I mean, as I said, I don't even know what it means. I think I think they got quite lucky in that inflation has hit hard and it allowed them to increase their prices. I think that played into their favor a little bit, but I mean, I didn't see anything on this report to give me a lot more confidence in the CEO or what they're actually going to
Exactly.
do to go into these high growth spaces that they're talking about over the next year. So
Yeah.
I think that maybe next quarter, the quarter after, the playing field will level out and they might drop back again.
Yeah, and I would say, you get it at almost 3.9% yield right now. That's historically quite good for
Yeah,
a company like Unilever. And the share price under 45. I've got a really large position, so I'm not adding anymore. But I would say if I wouldn't have a position under 45, we'll probably nibble a little bit in, but it's already like in my top five somewhere. So I'm staying on the sidelines for now. If it goes like just sub 40, like 39, I might buy a new leg again. But until that, no, I'm staying on the sidelines.
yeah. I mean, if I didn't have a position in Unilever, I probably would just ignore their price for the moment and wait to see when the CEO gets the chop and we start to see some real change. I don't know if I would even buy again until I start to see
Yeah,
something to give me some encouragement.
makes also sense. Yeah. Hey, while we are in Europe, then, right? Really quickly, Castellum, the Kungsleden, because they acquired this company, Kungsleden. The numbers are now finally processed in their quarterly report, and you can see it like their I said their quarterly income from property management went to 340 in Swedish crowns from
Yeah,
282 before. So this is what I like, right? These nice net acquisitions that are straight away, how I said, adding to the income statement. I really like this. And how I said, also the long-term net reinstatement value went to 259 from 220. So effectively, you could say this is kind of a fair value price, or I said book value price for the company. It's currently trading at 195. So I bought some even before the earnings report already. I'm slowly building up my position. My average price is 2 times at 200. If it goes to 180, I will buy another one, another slot. You can get it now for 3.9% yield. It's a real estate company in Sweden. I guess the largest one from North Europe. And they are one of those few companies like Unilever and Shell that are paying a quarterly dividend. So that's also what it makes it really nice
Yeah.
for me as a cherry on the cake.
Nice. It's a company that you seem to really, really like and really enjoy, and they seem to be doing quite well.
Yes, and what's probably I always get this question like, "Oh, what do you do with it? 30% dividend tax." You know, I said I'm just in 2 years from now I'm going to reclaim the dividends, and I will learn how easy it is. I look at the tax after yield, and then it's what is it like a 2.6% yield tax after tax. So that's still pretty good if you look to other stocks that are trading now around 3% or something like that. So it's not too bad from that point of view.
Yes, it's not too bad compared to stocks, but if you were to compare to REITs, it's not great either. That's
No, no, it is lower yielding. That's true, but I believe it also doesn't need to pay out 85 or 80% of their how's it of their income and dividends. So you have got a better margin here.
cool. Okay, maybe let's move back over to America. I just want to talk about Texas Instruments for a moment because they're a company that I would like to own more of. I want them to be kind of a core holding in my portfolio. And again, I mean, their earnings just have been pretty good. So they beat expectations, I think, by about 11 or 12%. Revenue was up 14% to 4.9 billion. Net income was up 25%. Earnings obviously goes up with net income was 25%, and their operating income was up 36%. They also declared their dividend of, I think it's €1.15 per quarter as well, which will be paying out soon. Their free cash flow was 1.7 billion, and total dividends paid was just over 1 billion. So it's around a 63% payout ratio. What I found interesting was that the share price dropped over the last couple of days, and that is purely based on analysts who are beginning to see momentum fading, and they just wrote a couple of columns on this, and it's starting to affect the share price. I know Texas Instruments did say that in quarter 2 they are expecting a little bit of headwinds, so their revenue is going to drop to about 4.2 billion, and their earnings will drop as well. Um, but overall, I thought it was quite strong, and thanks to these analysts, it looks like I might start being able to get back in and buying at a decent price.
Yeah, I'm actually quite happy with this, and I hope that the analysts bring the stock even further down. I mean, my fair value price is 166. I bought them like
Yeah,
I think in February at that price. I will buy again at 150, which is like 12, 13%. Why not? If there's a little bit more headwind in the stock market. Um, I'm very bullish on this calculator producer that also does more in chips nowadays, and with the same quality, I would say. So yeah, I could also see it becoming a core holding for me. I've been more adding to Intel, of course, over the last year. Texas is something new for me. Long term, I'm probably more bullish on Texas. Intel is just showing me a better value at the moment. That's why I bought a little bit more, but I would love it to be the way around.
yeah. I think Intel is pure turnaround, and probably value is a hard word to say
Exactly,
when it's a
exactly.
turnaround, but there's maybe a little bit more value to be had there.
Yeah, correct.
Whereas Texas Instruments is a really strong and growing company. They just because of that they're richly valued, and you have to find opportunities to buy them. But certainly, if they start coming down towards the 150 mark, I'll be loading up the truck as they say on Twitter.
Nice one, nice one. So, if you don't mind, then I'll go quickly further because there's another company which I own also quite a bit from, and which is also very popular in the dividend growth investment community, and it has some challenges, and this is 3M. And what I found really interesting is that 3M, the first thing they announce in their quarterly report is that In response to feedback from our shareholders and to provide additional clarity on the strength of our underlying business performance, starting in the first quarter, we are reporting adjusted earnings to exclude costs for significant litigation. Now, I understand that they do this, and it makes it easier to read. Still, they had the earnings last year around this time of $2.95 and now $2.65 adjusted EPS and GAAP EPS of 226. You know, I'm for me, I always start wondering, like, is this not just a cost of business, right? People say it is a one-offs. I'll look a little bit to the other side at the moment because 3M has a good track record of being genuine to shareholders, right? So
Yeah.
I'll give them a pass on this one. I just hope that they get the litigation quickly under control because it's like European companies struggle in America, American companies struggle in Europe.
Yeah.
Yeah, they don't understand how it goes here with litigation, and we've seen the same with Bayer and such reversed. So I have a feeling that this can take a while for 3M, and that it can even get more ugly for them in the upcoming time. What I would also like to know is that they returned 1.6 billion to shareholders via dividends and share purchases, right? What is important to know here is that they had a cash flow of, what was it, 700 million or something like that. So they are at the moment returning more cash, let's say, to shareholders than they get via their cash flow statement. So they're a little bit underwater from that point of view, but their balance sheet is strong enough. They can weather this for now. I wouldn't like to see this continue for another 2 or 3 quarters. That will get me concerned, but for now I'm okay. I mean, are they a dividend king? Do they already have 50 years?
Yeah, they're Dividend King. Yeah.
Yeah, exactly. So, still they're expecting earnings to be around $10, right? So you can pick it up at the moment for 14 price to earnings, which is really, really not bad. And this includes already taking the litigation costs into consideration. From that point of view, it is really attractively valued now with a 4.13% dividend yield. So if it drops another 10% to the low 130s, I will probably buy some more again.
I mean, the current yield is way above their average. The current yield of is nearly 4, so 4.1%.
4.13, yeah.
Yeah, so the average historical yield is way down 2.5%. So from a yield perspective, it looks fairly attractive. But honestly, just hearing you talk right there, I'm glad I made the decision to sell them. We know we all have different biases, and sometimes because they're a Dividend King, we might give them a little bit more slack than what we would if this was, I don't know, someone like IBM, for example. But they've made it quite clear that this litigation is quite real. It could impact them. The share price is getting hit. I know they didn't have as good as earnings as they wanted. I think they missed estimates. So at the moment they're falling, and I don't really want to catch a falling knife. So I'm happy to wait. They're not going to go away. The company won't go bust by any means. Their products are pretty much everywhere. But I again, before I will even think about buying them again, I want to see them maybe hit a bottom and start to turn the curve a bit and start to see a little bit of growth from them. But I think it's going to be another year or two, at least until they get this litigation under control before we start to see anything.
Yeah, I think as well. Look, it's really simple, right? I don't sell my stocks because of overvaluation or something like that, or because of this necessarily. I usually sell when the fundamentals really changed in such a way that I expect a dividend cut to happen, or when a dividend cut happens.
Yeah,
And I don't expect this at the moment with 3M. And what they have been doing is, like, in 2020, their quarterly dividend was 147. In 21, it was 148, and now they hiked it to 149. So clearly, they are really conservative at the moment with the dividend hikes, right? It's not beating inflation, let's say. So we shouldn't have it from the dividend hikes at the moment. But the yield, on the other end, like you mentioned, is historically really attractive right now. So yeah, I can imagine if you're more like also the value investing mindset, that you sell overvalued stocks, or when you're bit concerned, then probably there are better opportunities still ahead of you to jump into this stock. I agree with you.
Yeah, I mean, think of the red flag there. You've already mentioned that cash flow hasn't covered the dividend in this quarter. It's just one quarter. It's no big deal. We don't judge on one quarter, but it's still a bit of a red flag if it happens next quarter and next quarter.
Exactly.
We're also seeing decrease in dividend increases. We've seen that with other companies before, AT&T, for example, until it gets down to a trickle and they're just increasing it by 1 cent just to keep the status until eventually they can't afford it and then they have to cut it or spin off their business and cut it that way. But there's always warning signs. So I'm just curious, and even from a learnings perspective, is this company worth watching to see if the warning signs were there early enough that we could catch them?
Yeah, but yes, you're right. But for me, almost everything is in green. The payout ratio is around 60%, right? A relatively low multiple. Revenue is growing, earnings are growing, a credit rating of A1. The only thing is that they have a relatively high debt compared to their equity. Here, we should not forget that's also a reason because of stock repurchases. So it doesn't look too bad, really not from that point of view. It's just the litigation is like an invisible hand over this company. Yeah, and then on top of it, it's cyclical. So it does relatively worst during a recession or something like that, or economic contraction. So for me, it doesn't look that bad if you look only at the fundamentals. So,
Yeah,
but you're right. The I said it has some signs that have led to other companies cutting their dividends in the past. Yeah, that's true.
yeah. Well, it's interesting to watch. Okay.
So last but not least, then let's go back to this really really nice dark gold. It's not coffee, it's oil. And ExxonMobil reported earnings, and I mean, if you're like a cash flow investor, I think you should get a boner now, right? I mean, quarter four was really good last year in 2021, and the next quarter now again, what is it? 11 billion in cash flow, earnings of 14.8 billion of cash flow from operating activities. Earnings were, how is it? Excluding the write-off from Sakhalin from Russia, 8.8 billion, right? I mean, but with a company like Exxon, it's better to look at the cash flow. I mean, these are numbers, right? And they could pay everything from this, right? They could pay dividends from this. They could pay off debt. They could increase cash. They could do some stock buybacks, and they still had cash. I said, and they were still fine, right? So what they also announced is to hike their, I believe, share purchase program from 10 billion to 30 billion towards 2023, so the next 2 years. I mean, this is really, really a lot of shareholder wealth coming up. And I was doubting about ExxonMobil quite a lot. And by the way, they're going to repurchase in the next 2 years around 8% of their market cap at the current price. I was quite doubting because I felt like the company was in denial regarding I said, the transition that's happening in energy. I'm still thinking like this, but I must say that my undecisiveness during the pandemic is at least now enjoying me these master cash flows. But somehow I still have this feeling like probably I should ride it a little bit out and finally benefit from this. And then just at the moment when I think like, okay, it reached now the not the top, but maybe let's say peak earnings or something like that. And of course I cannot predict it, but that I feel like okay, I've benefited enough from all this cash flow that I swap it for Total Energies or something like that, who's more onto the energy transition. Sometimes I feel like maybe this is kind of I said a last hike for the oil industry where we see really above $100 oil per barrel because of Ukraine, inflation, supply chain, everything on top of it, right? With the pandemic as well. But I first want to enjoy the fat cash coming in from ExxonMobil now.
Yeah, it was going to be my question to you actually was, Are you happy that you hesitated? Because I know you were quite close uh, at points, but you always hesitated, and you never. When I asked you, you could never give me a reason why you were hesitating. There was always just something
Yeah.
stopping you. So I'd say you're
Yeah,
quite happy now.
I think I always hesitated because it didn't cut their dividend or anything like that. And for instance, Shell did. And I must confess that if you look at it from that point of view, I trust ExxonMobil more to focus on shareholder return than Total Energies. Just from a policy point of view and how they look at shareholders, I think Total Energy is a French company, probably also more focused on, on the French government,
Yeah,
the woke community and such. And I guess I have that also a bit in the back of my mind. And then, and I have already a large position in Shell. So if it's not Total Energies, then what then? BP, I'm also not interested in.
yeah. Maybe more into renewables as that takes a little bit more of a stranglehold on the market.
Yeah, but I struggle to see how renewables can generate similar cash. Yeah, and this is also what I feel is the biggest risk for a company like Shell and ExxonMobil. Can they get similar profit margins? So that's for me a big question, really a big question at the moment. If I think around that, I quickly end up with Siemens because at least they are a producer of a lot of the equipment for, I said, for renewables. But Siemens, I prefer to buy them a little bit more towards the bottom of the cycle.
Yeah, yeah. I mean, Shell are comfortable that they can generate the same returns, so it'll be interesting to. It'll be.
Yeah,
We'll see.
Shell is, but I'm not yet.
I'm not yet either, due to the cost and the capex involved, but we'll see. We will see. Okay, I think it's a good time to move on to some of our listeners' questions. I think we covered 6 or 7 companies there, which is quite a bit for one session. But I might start with the first question, which is a question about a company called Neste. Have you ever heard of them? It's not Nestle, by the way. It's a Finnish company that are a pioneer in renewable energy, diesel, and renewable chemicals, and they're a Finnish company. So, have you ever heard of them? And have any thoughts?
No, I have never heard of them. But it was really nice that I forgot the name. I should have captured the name. That he reached out to me. And so, what I liked generally about the company, I mean, you should go to their investor relations website, I would say, and just have a look at it. It comes across actually quite nice. And it's a refiner, right? So if you think about it, they usually have a little bit of thin margins compared to, for instance, companies like Shell that have also an upstream business, right? There's more lock-in of profits. But what takes me away a little bit here is a 2% dividend yield, to be honest. For me, for such a business, and you know, which is cyclical as well, and you can see it. They were trading in at I said last year January at 62 euros, now at 44 euros after they recovered from 34 euros. So you would have almost experienced a 50% drop in the last year. Although of course it came from what is it 17 euros back in 2018. So we cannot ignore the growth that they also made since then. But it's not giving me enough shareholder return for the volatility that you will experience with this company. So if anything, and if I would be interested, I would not buy it now. But here also again, more towards the bottom of a cycle. But historically, since even if you go back the full decade, they did really, really, really well. And you would have got really a lot of wealth if you invested, let's say, somewhere in 2011 for €4. You would have made a 10 bagger by now.
Yeah, I mean, I didn't look. I only looked at some of the fundamentals that we spoke about on our show that we look for. Look at revenue, earnings, top line growth, bottom line growth, free cash flow, and dividends. And if I look at the earnings and maybe even the top and bottom line growth, it's been quite choppy over the last 10 years, which for me is not what I'm looking for. The dividend has been looks like it's been increasing, but it's not always covered by cash flow. I think there's a period of about there's 3 or 4 years within the last 10 years that free cash flow has not been covered, even though they have continued to either pay the dividend or keep it steady. I think that it cut in around 2014. I think just looking at the chart. So it could be a good company. I'm not sure, but it would not pass my initial screener, so I probably wouldn't take it any further than that.
Super. Okay. Then the next question is from the Alex, who visited us not too long ago on the podcast, and he's asking about what do we think about Johnson and Johnson and the adjustments they make to their net income and EPS related in large part to what is called intangible amortization expenses. Well, I can actually answer this because what he's mentioning is like then you have like adjusted earnings and normal earnings, and there's an increased gap there. So, Alex, you see this with most of the pharma companies. Just look up any biotech company or pharma company. They almost have this all because they need to amortize their R&D expenses. And that's why you see companies like Bayer, Roche, Novartis, they all talk about basic APS as an example, or core APS. And that's for that reason, because the R&D is really, really a lot of money, and they prefer to uh, keep that out of the numbers. I don't fully agree with it because it makes their numbers always look better, like always over let's say 20 years or something like that, and it is a cost of business in my opinion, but they typically seem to take that out of the adjusted numbers that they are using, so it's normal practice in the industry.
Cool.
And Johnson is now a pure play pharma, right? Once they will spin off their consumer business, so we will also get the patent cliffs with Johnson going forward. Of course, there's also part of diagnostics in there. But yeah, there's increased risk for me now with this company.
Cool. Simon Stott has asked us. I think the other day he stepped onto an escalator and noticed that it was made by a company called Kone. I think they're also a Finnish company, and if I'm not mistaken, somebody mentioned them on our program before. But I think he hasn't done this before, maybe, or maybe he has done before, where he just comes across a product when he's out and about and then Googles it and finds them. So he's asking us, beyond screeners, how else has some of our stock picks come from?
Well, actually, similar. I just look around me and then suddenly things occur to me. I'm usually mostly disappointed because they are not listed. Specifically in Europe, we have a different culture, right? Many companies are private, like Lego, to give the best example, or IKEA, I believe, as well. But we have one blessing here, EMF, and that's we get so many stock picks here and recommendations towards us in the community, towards the podcast, that it's so easy for us to discover new stocks. I mean, the Kleine Capitalist was tonight talking about Thule, right? Thule, this with all this gear for outdoors, right? Whether it's the thing that you put on the roof or the bike carrier. I mean, that's just being great. That's just really great of being part of the dividend investing community, right? But yeah, just look around you, right?
Exactly. I think that's probably the best. I answer this on Facebook as well. Sometimes I do that as well. You stumble across something that you use and you think, oh, I wonder what company makes this, and sometimes you find they're part of a larger European network, and you find some good companies. And then obviously, as you said, we get lots on this podcast. There's lots of in the Facebook and Twitter groups as well. There's lots of companies thrown around, so it's quite easy to find new companies. Okay, Billy Pritchard has asked us any thoughts on ticker symbol TX, which is Terranium, I think it's called. So it is a long-term hold steel play, in his opinion.
Yeah. Yeah, I'm not a fan of steel companies, to be honest. I'm struggling always with this business because there's a lot of, how do you call this, where like protectionism, American protectionism, European, China. So I struggle with this. Like depending on the government, the wind blows to the east or to the west, and it's either favorable or unfavorable. So that's my issue with the business as such with steel. Secondly, it doesn't pass my screeners because it doesn't have a consistent track record of dividend growth. But I can understand why Billy likes it because it has a 6% yield right now, and this is a high yielding company, right? So I understand why he looks at it, but it doesn't pass my screener.
It would actually pass my screen. I think you're looking at Seeking Alpha, which makes it look a little bit more choppier than what it is. It did miss a dividend, I think, in 2019, but it went from 120, I think that's in dollars, yeah, 120 in dollars to 210 in 2020. So it more than increased. I think the average increase was 10 cent before that. They missed a year and then they did it by 90 cent. And they've been paying consistently since 2009, I have here on my screen. So from a dividend point of view, it does look fine. Um, and looking at the rest of it, revenue has been trending upwards since 2003. Free cash flow has been trending upwards. So has earnings per share. So from a fundamental point of view, it looks okay to me. I think I also mentioned on Facebook that I don't know enough about the steel industry as a whole. I don't know if it's quite cyclical or when the best time to buy. It does look, I know the yield is quite high, but it still looks quite richly priced at the moment. But again, that's just based on my little understanding of the market. But I have added it to my watch list because it would be quite interesting to maybe understand that market a little bit better. But no, it does look like an interesting company.
Super, good. The next question is from Mark Orossi, and he is asking whether we have a mistake diary, right? Do you capture your mistakes and try to learn from it?
Ah, that would be too big to read. I don't. I don't. I suppose the closest thing I have to it is my blog, even though that has been neglected for the last 2 months because I've been so busy. But anything that I do, I normally write on there, including my mistakes. So that would be the closest I would have to it.
Yeah, it's for me the same. My blog as well, and I'm quite open on it when I make mistakes. And I might not say like use the term mistake as such, but usually when you see me that I sold something, like actually Philips, right? I got rid of Philips this week. I just made a mistake there. I was too optimistic, probably around how the company could deal with this issue that they currently have. And I sold because it was really easy to sell. I only bought few shares to start following the company. I did the same with SAP like 1.5 year ago, and also SAP disappointed me. Philips the same now, so I got really quickly rid of it again. So these were not necessarily mistakes, yeah, but it was in the sense of I lost a lot of money on this. These were rather mistakes from like that I even wasted my time in looking into them.
Maybe you didn't waste your time. They could have been good opportunities that just didn't play out as expected. And kudos to you for selling straight away because lots of people would hang on waiting for their thesis to play out. So I would
Yeah.
I would not say it's a mistake. I think it was a
For me, it
good.
feels like that.
Yeah.
Let's say like that.
Okay.
He has also a second question, and he's asking about Texas Instruments in the quarterly report, where he saw entries for overpaid and underpaid retirement plans. He hasn't seen anything like that before, and he asks, "Do we know why they have those entries? And it is because such amount is considered as material or not?" So first of all, they need to put it on the balance sheet because it is effectively a liability, right, or an asset. In this case, it's I believe both. And the underfunded retirement plans are seen as an asset, which is really interesting. 383 million. So if they don't pay our retirements, it's an asset. But there's also overfunded, so they pay too much, and the underfunded retirement plan is liability. Yeah, so it makes sense. Sorry for that. I think for me, it's not material anything here on the balance sheet. I wouldn't worry about this is the hallmark. Have a look at UPS, I believe, where I think it was UPS, wasn't it, EMF,
Yeah,
where
it
it's
was.
like 20% or 25% of the balance sheet or something like that?
Yeah. Yeah. I
Yeah.
I'm struggling here. overfunded retirement plans is an asset. So they've paid more money into a retirement plan
Yeah,
and it's an asset.
yeah.
Explain that to me.
Uh, I can't.
Okay. Okay.
Yeah. I honestly, I will probably need to open up my book about accounting. I've got such a book with more than 1,000 pages. It's probably in there.
Yeah.
I can imagine that they maybe had one time a good cash flow, taxes, and that they just thought, like, you know what, let's throw some more money in the retirement plans in case we have in the future maybe some bad times that we can still count on that.
Yeah. Okay. Centrino has asked us a question, and the question is he's been investing for 18 months and he's struggling to divide his buys and spread them over the month. I suppose he's been impatient and panic buying on the first red day. So have you got any tips to better spread his buys out?
No, I think he's being penny wise, pound foolish here. Centrino is one of our most engaged listeners since episode one, probably. And the fact that he has been buying every month for 18 months is a perfect example of dollar cost averaging. The fact that he buys it in the month on the first red day doesn't matter at all. If he looks back 20 years from now, he only remembers that he bought it like once a month and he will do really well because of that. So, Centrino, it sounds rather like you're overthinking. It really doesn't matter. We know people that only buy on the first day of the month to even take that kind of timing the market out there. So if it makes you feel more comfortable, you could do something similar. Just take it always the same day in the month, and you really exclude out your emotions. But I think you're doing really well. I would not start to buy something every week, specifically not if it increases your cost basis because of the commissions. I think you're doing really well, Centrino. So I would not change a thing.
Yeah, what European DJ said. I mean, I wouldn't focus as much on a red day because that red day might be the same price as it was the day before or the week before. I would just have maybe a price point in mind that I'm happy to own a company, and if it's underneath that, just buy it,
Exactly.
regardless if it's a red or a green day. But I echo the sentiment by European DJI. The fact that you are consistently investing every month will stand to you, regardless if you have no cash for the rest of the month or not. I mean, I think you're doing perfectly fine.
I don't know if you have the same, but every time I buy a stock, the next day it goes lower.
Oh yes, 100%. Always happens.
Exactly. So it happens to all of us. Okay, his second question is about Omega Healthcare investors. And he says they might announce a dividend cut because he read it somewhere, I believe, on Seeking Alpha or something like that, because the dividend was not properly, almost not covered over the last few quarters. And then he's also asking whether it's smart to buy at X dividend date, as the price often drops then too. Um, I can give a comment on the first one. For me, yes, Omega Healthcare is one of the most riskier positions in my portfolio. Already for the last 5, 6 years, I've been, I said, capturing their dividends since then. I mean, collecting their dividends since then, and it gave me a lot of wealth so far and a lot of reinvestment opportunities. You need to be feeling comfortable with this stock in your portfolio. Yes, it might get cut, but until then, I'm kind of collecting a 10% yield. But maybe you would like to say something about the ex dividend and the price often dropping then?
Yeah, I mean, the price is nearly always going to drop pre-market because essentially on ex dividend day, it's going to drop by the amount of the dividend. So the dividend is effectively taken off the share price and returned to us as shareholders. So you'll hear a lot of arguments around that with growth investors that you're not actually making any money because the money's been shaved off. Now we know the market fluctuates, so by the end of the day, the stock price could could recover so you get the dividend and the stock price. But to answer your question, is it smart to buy at ex dividend date? I would say it doesn't matter. It's up to you. You're just going to miss the dividend if you buy it at that day. So I'm assuming you're a dividend investor. You may want the dividends, so you may want to invest before that. But I think it goes back to what I said just before that. Have a price you want to own a company at. If it's below that, just buy them.
Super. Thank you. Hey, the next question is from Jens Minator, and he's asking whether we have any thoughts on Volkswagen or other car makers. Great yield, low PE, decent yield, and semi-decent dividend growth.
I've been turned off Volkswagen since their escapades on, is it 30 Money, or the series on Netflix, and I have never looked into them since. I suppose when management is that dishonest, it's hard to gain my trust. But they might be an interesting company in terms of, we know this EV is becoming big. We know Tesla obviously is one of the big companies out there, but electric vehicles will be coming more and more to the fore over the coming years. And I would imagine Volkswagen, as big a brand as they are, will be on the forefront of that. So I haven't looked at them, so I don't know, but it could definitely be a good choice if you're interested in cars and electric vehicles going forward.
Yeah, I have issues with the car manufacturing industry in general. I don't believe that they have I said, the moats and such to provide me with ever increasing dividends. And if there would be one car company, it would be for me General Motors. But for instance, General Motors has a flat dividend since 2016. I believe, didn't they even stop paying dividends at the moment? Yeah, I believe so. I think they already don't pay dividend probably for 1 or 2 years. So for me, it, I can't trust that Volkswagen will continue to pay their dividend for the next two decades and also grow it. As soon as recession hits, they will be cash constraints. I just can't see it. I really just can't see it, and that's why I'm staying away. It's the whole industry. I'm not discriminating here on car manufacturing. It's just the whole industry I don't trust.
Okay.
Then the next question is from Dividend Wave, and he's asking which stock got unfairly hit this week. So what ended up looking cheap in our opinion?
Oh, I don't know. I don't think I've seen enough of them to comment. Any earnings that I've seen, I think it's been pretty fair with the share price. I did mention Texas Instruments had a great quarter, and they still dropped, based on future outlook. So
Yeah.
maybe someone like that. I don't know.
Yeah, if I look at non-dividend stocks, I found Google a little bit punished too hard. I think it's starting to create a great opportunity if you want to think about non-dividend stocks. But other than that, I think everything was fair. Yeah. Also Intel, right? We didn't discuss it today on the podcast, but also Intel for me was rightly so punished a little bit.
I think Intel was as expected. We've
Yeah.
spoke at great length at this, and we know there's always this sense of optimism, and then the 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 real story is nothing's going to change for 2 years. Or well, we're probably nearly 12 months into that story, so we now got to see the next 12 months and see how that plays out, and
Yeah.
hopefully they go on from there. But if not, we could see them dive even further. One thing I did notice though was, Meta or Facebook. They took a nice bump after their earnings, which is quite a shame, because I had an order in for around 170, which is now not going to get triggered.
Yeah, it's funny that you say that. I was in the 172. I was thinking like, maybe I should buy like a few 5 shares of Facebook again, just to add up a little bit to my position and take use of this opportunity. And then it bumped up as well. But yeah, that's how it goes. EMF, penny
It,
wise, pound foolish, right?
exactly. It's I suppose there's probably lots of people out there, but it's just my love of round numbers, and
Yeah,
170 was a
same here.
nice a nice round number, and I was dismayed when I woke up to see that their share price jumped to nearly 200. So.
Funny. Hey, the last question there from Thiago, and he's asking Amazon is down 13% after lackluster earnings. At what price would you consider buying them?
Oof. Oh, I don't know. What are they now? 2,500
I have no clue.
in around that. I mean, I don't think I don't think I could pay that just to have one share. I don't know. They'd have to come down to three digits.
Yeah. I think around $600. I would buy it because then it would have a PE of 15. Yeah.
Yeah, yeah. Hey, it was $600 back in 2016. So who knows?
Yeah, exactly. Who knows? I don't know. I don't even give it thoughts around this at this level. I'm not even wasting my time on it.
Yeah.
Good. Hey, we're at the end of the show, EMF. We recorded a little bit late in the weekend, but thank you so much still for having time. I know it was a bit of an effort for you this weekend, so I'm really happy that we could continue the rhythm.
Yeah, yeah. It's been a bit of a challenge. The sound might be off. I'm getting renovations done in my house, so my normal office is ripped apart for now. I have no power in half the other house, and my PC is out of action. So, but we'll make it work. That's why we love doing this. We'll make it work no matter what.
Super. Hey, hey, everyone, if you're still stuck till the end here, thank you so much. You're the most loyal listeners I can imagine. And for now, have a great week ahead and enjoy May and all the new dividends that are coming up.